Okay, we're going to go through step one, before tax cash flow. Now, the investment problem, there are 7 steps, and let me scroll through the 7 steps very quickly here, and I hope it shows up on the screen. But 1 is before tax cash flow, 2 is calculating taxable income, 3 is after tax cash flow. All right. So the first 3 steps have to do with calculating cash flow, right? And the bottom line, or the goal for investment purposes, is typically after tax cash flow. How much money is left over after everything? Okay, this is the money left in the investor's pocket after all expenses are paid for the property per year. Steps 4 and 5 have to do with the sale of the property. And in our example, in this case, it's at the end of the 3rd year. We're going to sell the property. Step 4 calculates the before tax equity reversion. Reversion just means the sale or the property reverting. Step 5, it's a big step, and it's just to calculate the capital gains tax. Okay, so it's a long step, a little bit tricky, but the goal is just to calculate the capital gain, so we can calculate our capital gains tax on the sale of the property. My favorite steps are steps 6 and 7. These are fun. Okay. Step number 6 is discounting the cash flows. All we're doing in step 6, we're not calculating any new cash flows. Okay. We've already calculated the cash flows in steps 1 through 5. All we're doing here is putting the cash flows on a table for years 1, 2, and 3 in this case. And then we're discounting the cash flows back to present value to calculate the present value of the total benefits. And then step 7 is real fun and real easy. It's just the decision. And we're going to use the traditional NPV, net present value decision criteria, where we look at the present value of the total benefits versus the initial investment to get into this deal. And we're going to see if it's a positive NPV investment. If it is, that's a go investment. If it's negative, that's a reject. Okay, it's don't invest. Okay, so that's where we're going, but let's go all the way back to step 1. And it's important to take this problem in small steps. Okay, it is a long problem, and if you try to look at it all in one big piece, you're going to get overwhelmed. But if you take it into steps, I think it's much easier. I'm going to cover up some of the problem here so we can focus on the cash flow statement. Okay, so this is another strategy to focus you on the cash flow statement first. What we're going to do is we're first going to start out by calculating potential gross income, PGI. And we can use the initials, the abbreviations. Okay, I know what PGI means, and you should know what PGI means after we get done with this. Less vacancy and credit loss. So from PGI, okay, PGI is potential gross income because it's not actually what we collect typically. Okay, it's potential gross income because it assumes the property is 100% leased all year, and they're getting market rents for the units. Okay, so sometimes we have vacancy and sometimes we have below market rents. So that's why it's called potential gross income. It's the potential of the property, But from that, we subtract out the vacancy and credit loss. That gives us EGI, effective gross income, and this might be much closer to rental collections. Less operating expenses. Okay, operating expenses are the expenses to maintain and operate the property on a regular basis. It includes typically things like property insurance, property tax, some management fees, utilities, maintenance, repairs, and reserves. But once we subtract out the operating expenses, we have what's called NOI, net operating income. And NOI is very important to appraisers because this is the productivity of the property. All the numbers above NOI are property specific. Okay, the numbers below NOI are investor specific. So it might depend on the type of investor that owns the property, what the debt service is, and what the tax rate is, and so on. But everything above NOI, it doesn't matter who owns the property, you're still going to have a market vacancy and collection loss, and you still have operating expenses to operate the property. So where appraisers might stop at NOI, investors want to know how much money is left in their pocket. And NOI is not money left the NOI is not the money left in the investor's pocket, because most investors borrowed money to get into the investment, and they have a debt service, and investors have to pay taxes on their income. So we have to calculate taxes too. If we subtract out the debt service, and this is the annual debt service, okay, this potential gross income is annual. Everything you're looking at here is annual. We're going to do it for each year, year 1, year 2, and year 3, or 2007, 2008, 2009, however you want to look at it. If you calculate the debt service, which you should be able to, okay, it's just the monthly debt service multiplied times 12. Subtract that out, that leaves you with what's called before tax cash flow, BTCF. And that's the goal for step 1. Now, looking at the numbers, what you might want to do is start out with year 1 only, and then go on to years 2 and 3. So using this strategy, starting with year 1, we're going to calculate PGI first, and PGI, again, is if all the units were rented at market rates, okay, in this case we have 2 units, the market rental rate is $725 per unit, and then annualize it, multiply it times 12. So here we have 725 times 2 times 12, which gives us 17,400. Now the vacancy and credit loss, that was specified in our inputs, our assumptions, at 4%, okay, and that's 4% of PGI. So if you take 0.04 or 4% of 17,400, that's $696, okay? Subtract that out, that gives us effective gross income of $16,704. But that's not money in the investor's pocket, because over the course of the year, they have to pay operating expenses to maintain the property. We had $2,400 in fixed, $1,500 in variable, and we have a $700 reserve account. So the total operating expenses, $4,600. So if you subtract 4,600 from 16,704, that gives us an NOI, a net operating income, of 12,104. Now the debt service, okay, the debt service we calculated based on a $108,000 loan. Okay, so if you're doing it on your calculator, our PV is 108,000. Our number of payments, our N, was 30 times 12, 360, and our interest rate was 10% per year, or 10 divided by 12, per month, per period. Make sure that your future value is empty or clear. If you calculate PMT, you'll get the monthly debt service, and if you multiply times 12, you should get $11,373.33. Okay, and notice the debt service doesn't change each year. Each year it's $11,373.33. It's the amount, it's the rate the mortgage is being amortized that changes each year. The debt service is constant. It's the same payment every year. Now, subtracting out the debt service, that gives us before tax cash flow. So for the first year, it's $730.67. So we just created the operating statement, or the pro forma, for the property for year 1. Okay, from PGI minus vacancy and credit loss equals EGI, minus your operating expenses equal NOI, less debt service, that equals your before tax cash flow. Okay, once you have year 1 established, then I would suggest thinking about years 2 and 3. Okay, so how you go from year 1 to year 2? Well, you start at the top, and your PGI, okay, your assumption was that PGI was going to grow, okay, or the rental rate was going to increase by 5% per year. So your PGI for year 2 is going to be 5% higher than your PGI for year 1. And what you can do simply is just multiply the year 1 PGI times 1.05, okay, or 5%. And that would give us 18,270. So your PGI, if it's 5% higher than year 1, would be 18,270 in year 2. Now, while you're at it, you might want to continue on to year 3, and to go from year 2 to 3, that's just another 5% increase. So take 18,270, multiply it times 1.05. Okay, that will increase it by 5% to $19,183.50. So we just completed PGI for years 1 through 3. Going back to year 2, the vacancy and credit loss assumption holds at 4% of PGI. So if you take 4% of 18,270, you get $730.80. While you're at it, you might want to do year 3. Year 3 is 4% of year 3 PGI. Okay, so if you take 4% of $19,183.50, that's $767.34. Subtract the vacancy and credit loss from the PGI for each year. You get 17,539 for year 2, 18,416 for year 3. The operating expenses. Okay, remember our assumption about our operating expenses? This was a given, but our fixed was going to increase by 5% per year, our variable by 6%, and our reserves by 5%. So to go from year 1 to years 2 and 3, again, you can just multiply times the 1 plus the increase. Okay, so if the year 1 fixed expenses were 2,400, year 2 is 5% higher. Let's take 2,400 times 1.05. That gives you 2,520. Again, you might want to carry it on to year 3. Just take 2,520 times 1.05. That gives you 2,646. For the variable, the same thing. Okay, 1,500 in year 1. It's going to increase by 6%. Multiply times 1.06. That's 1.590. And then again, multiply it by 1.06 again. That'll give you the year 3 variable at $1,685.40. The reserves, same thing. Okay, increase by 5%, multiply times 1.05. That's 735. Multiply times 1.05 again, that's 771.75. Add up the total operating expenses, fixed, variable, and reserves, and then subtract it from the effective gross income. Okay, so for year 2, it's 17,539 minus 4,845. That gives you 12,694. So our NOI for year 2 is 12,694. For year 3, take your $18,416 less your $5,103. That gives you $13,313. Okay, so now we have NOI for all 3 years. Next step, subtract out debt service. Debt service should be straightforward. Okay, it's the same each year, no increases. Okay, but subtract out the debt service from the net operating income. That gives us $1,320 for the first year, $1,939 for the third year. So now we have before tax cash flow for all 3 years, and that was our goal for this clip. So take a look at it, think about it a bit, but when you're ready, go on to step 2 in the next clip.